$378 million. That's a pretty staggering number.
It is.
It's the number that jumped out at me from the latest Apex Trader funding report. That's how much they say they've paid out.
And you see that number, and you immediately get the appeal, right? I mean, the dream they're selling in 2026 is it's incredibly powerful.
It really is. You get to trade, say, a $300,000 account. You keep up to 100% of the profit. And here's the kicker. You risk absolutely none of your own money.
It sounds like the perfect setup. All of the upside, none of the risk. It's that free lunch everyone tells you doesn't exist.
Exactly. And, it sounds too good to be true. And that's because, well, it kind of is. The second you start digging, you go on Reddit or Discord, you find out that that $300,000 account is really just, it's a marketing term.
It's a mirage. You're not buying access to 300 grand. You're buying a very, very small margin for error, maybe $3,000.
And that's the reality check. That's where we have to start today. There's this massive gap between the marketing and the actual math of what you're signing up for.
For sure.
So that's our mission for this deep dive. We're going to navigate the, let's be honest, the sometimes treacherous world of futures prop firms in 2026.
Yeah.
We're going to break down the big three Apex, day traders, and my funded futures. And we'll get into the killer rules that trip most people up, and we have to talk taxes.
Oh, the 60-40 rule. Yeah, that's a huge one people misunderstand.
It really is. We're here to separate the, the marketing fluff from the cold, hard reality for you.
Look. These firms have gamified the market. If you don't know the rules of their game, you're just providing the entry fee for someone else to win.
So let's start with the big picture. Why is this whole funded model exploding right now? It feels like overnight everyone just stopped talking about margin accounts.
I'd say it comes down to two things, really. Capital and psychology. Think about the old way. You save up, say, $20,000. That's your own cash. Maybe your emergency fund. You put it in a brokerage account.
And every tick against you feels like a punch in the gut.
Exactly. That's not just a number on the screen. That's your rent money, right?
Yep.
And that emotional pain leads to terrible decisions. Panic selling, revenge trading.
All the classics.
Right. So firms like Blue Guardian, they talk about this psychological shift. With the funded model, you pay a one-time fee, maybe $100 if you blow the account.
You're out $100, not 20 grand.
It's a shield. It feels like a shield for your actual wealth.
Yeah.
You're renting their risk instead of, putting your own life savings on the line.
Yeah.
It's supposed to make you a more objective trader.
And we're talking specifically about futures here, not Forex. That seems like a really important distinction.
Oh, it's massive. It's all about transparency. See, Forex is decentralized. It's the Wild West.
Right. You and I could be with different brokers and see different prices.
Totally. You hear those stories about slippage where your order gets filled way worse than you expected. But with futures, we're all trading on the same exchange, the CME.
The Chicago Mercantile Exchange.
Exactly. So if you and I both buy the S&P 500, we get the exact same price. The prop firm can't mess with the data feed to hunt your stop loss because that feed comes directly from the exchange. It's a level playing field.
Okay, that makes sense. So that's the why. Let's get to the who. The big three. Let's start with the 800-pound gorilla in the room, Apex.
Yeah, Apex is all about pure, massive volume.
Yeah.
They have millions of site visitors a month. They're always running these insane 80–90% off sales.
They just want to get as many people in the door as possible.
Their model is basically throw enough traders at the wall and see what sticks.
And the big hook is that you can have up to 20 accounts, right? And copy trades between them.
That's the power move. If you pass 20 evaluations, you link them all up, you place one trade, and it copies across all 20 accounts instantly. A $500 winner becomes a $10,000 winner.
I mean, that's just insane scaling. But there's always a but. We have to talk about their rules, specifically this trailing drawdown. The forums are full of people complaining about it.
It is, without a doubt, the #1 reason people fail.
Yeah.
It's designed to be tricky.
So break it down for me. How does it work?
Okay, in a normal account, you have a fixed floor. You start with $50,000, your floor is $47,000, you have the $3,000 buffer.
Yeah.
Simple.
Right. Don't lose $3 grand. Got it.
With Apex, that floor moves up with your profits. But here's the evil part. It trails your unrealized profit.
My paper profit.
Your paper profit. Let's say you're in a trade, it pops, and you're up $2,000 on the screen. You're feeling good.
But I don't sell yet. I think it's going higher.
Right. But then the market pulls back, and you end up closing the trade for a $1,000 gain.
Hey, $1,000 is $1,000. That's a win.
In the real world, yes. But with Apex, because your equity peaked at plus 2,000, your drawdown limit moved up by 2,000. and it doesn't come back down.
Wait, hold on. So I made $1,000, but I lost $1,000 of my buffer.
Exactly. You are now $1,000 closer to failing the account, even though you just had a winning trade. It's brutal.
So winning can actually hurt you if you don't time your exit perfectly at the absolute peak.
Yes. It punishes you for letting trades breathe. It forces you to become a scalper, taking tiny profits constantly. You can't have any kind of normal pullback.
Wow. Okay, so that's Apex. They're for the hyper-disciplined scalper who wants to scale. What about the disruptor, daytraders.com?
Totally different feel. It was founded by a tech guy, a CPO. Their platform, Project X, plugs right into TradingView.
Which is huge. Every trader I know lives on TradingView.
It's a seamless experience. But their big headline, the thing they shout about, is the profit split.
100%.
A true 100% split. No 90-10, no 80-20. You keep everything you make. And they claim they process payouts in like 32 minutes.
That's crazy fast. But looking at the research, there's a big catch about being in sim versus live.
Always a catch. With day traders, to get a live account, where they're actually putting real capital behind your trades, you have to complete 6 separate payouts first.
6. So you're basically in a simulator for months.
Pretty much. It's a simulated funded account. They pay you from their own revenue, which is likely coming from all the evaluation fees people are paying.
It's like a video game. You have to prove yourself over and over again.
It is. You have to prove you're consistently profitable for a long time before they trust you. It's a high bar, but if you clear it, the reward is the best in the business.
Okay, so that brings us to the middle ground, My Funded Futures, or MFFU.
Yeah, they're the user-friendly option. Their big thing is attacking the hidden fees.
Like activation fees.
Exactly. With Apex or day traders, you pass the test, and then, surprise, you have to pay an $85 or $150 fee just to turn on the account.
Which, if you have 20 accounts, that's thousands of dollars.
It adds up. MFFU has 0 activation fees, and their drawdown is much more forgiving. It's end of day.
So it doesn't punish you for those intraday swings like Apex does.
Right. It only looks at your balance at the close of the market. It gives your trades room to breathe. Much better for someone who isn't glued to the 1-minute chart.
But they have a catch too. The consistency rule, 40%.
Yep. This is the anti-gambler rule. No single trading day can be more than 40% of your total profits.
So if there's a big news event like inflation data and I hit a home run, say $5,000 in a minute,
you might be in trouble. If your total profit for the payout is $6,000, you can't withdraw. That one lucky day is too big a piece of the pie.
so I'd have to, keep trading small to water down that percentage?
You have to grind it out.
Now
They don't
that's
want
what-
home run hitters. They want people who can consistently hit singles and doubles.
All right, let's get to the real gotchas. We need to drill into the math of this $100,000 account myth.
This is maybe the most important thing for you to understand.
Huh?
When you buy a $100,000 account, your actual risk limit, your max drawdown, is usually just $3,000.
So it's not a $100,000 account, it's a $3,000 account.
It's a $3,000 account with insane leverage. The firm will let you trade, say, 10 or 14 mini contracts on it.
And put that in perspective for us. 10 mini contracts is a lot of risk.
It's a ton. One mini contract on the S&P 500 is $50 per point of movement. 10 contracts means you're making or losing $500 for every single point.
And the S&P can move 6 points in, a few seconds?
Easily. So a 6-point move against you is $3,000. Boom. Your account is gone. In an instant.
Even though the dashboard says you have $100,000 buying power?
It's a trap. It's like they're handing a teenager the keys to a Ferrari, but only putting a thimble of gas in the tank.
Yeah.
The second you floor it, you're done.
And when you're done.
You pay the $80 reset fee to try again.
And there it is. That's the business model.
For some firms, absolutely. It's the churn. They know most people will see the big leverage, get greedy, blow up, and pay to reset. It's a steady stream of revenue.
So proper risk management would be to completely ignore their contract limit.
100%.
Yeah.
You have to look at the drawdown. If you have $3,000 of risk capital, you should be risking 1 or 2% of that. So 30 to 60 bucks a trade.
But you can't even trade a mini contract with a $60 stop loss.
You can't. You'd have to trade micros, which are a tenth of the size. But that doesn't feel as exciting as trading with $100,000, does it?
It's an ego trap.
The whole model is an ego trap. They are banking on your ego being bigger than your math skills.
Okay, let's say you're smart. You trade micros, you respect the drawdown, you make money. Now you have to pay the tax man. Let's talk about the 60/40 rule.
Right, this is the silver lining for futures traders. Under IRS Section 1256, futures get special tax treatment.
Better than stocks?
Much better. 60% of your profits are taxed at the lower long-term capital gains rate and only 40% at your normal higher short-term rate.
Even for day trades, if I'm in and out in 5 minutes.
Even then, with stocks, a day trade is 100% short-term gains, taxed at your highest income rate. With futures, you get this blended rate that can save you a ton of money.
But, and this feels like a very big but, does this actually apply to these prop firm payouts?
This is the gray area that trips everyone up. Remember, we said a lot of these accounts are simulated.
Right. You're not trading real money, at least not at first.
So if you're in a sim account, you're not technically trading futures. You're a contractor. They're paying you a performance fee. You'll likely get a 1099 NEC form.
Which is just regular income?
Regular income plus self-employment tax. You do not get the 60/40 tax benefit.
Wow, so you only get that huge tax break once you graduate to a live account.
In most cases, yes. Once your orders are actually hitting the CME, then you're trading Section 1256 contracts. But for most people starting out, don't just assume you get that tax break. You have to talk to a CPA.
That is a critical distinction that could cost you thousands if you get it wrong.
It really could.
So let's zoom out. The current market in 2026 is, let's call it choppy. The NASDAQ is in this churn zone. Does that kind of volatility make these firms more attractive despite all the traps?
You know, ironically, I think it does. When the market is this wild, it's so easy to get chewed up trading your own money. One bad week can do serious damage to your savings.
But with a prop firm, your loss is capped.
Your loss is capped at the evaluation fee, $100 maybe. You're outsourcing the catastrophic risk. It's a buffer between a volatile market and your personal bank account.
Okay, so let's tie it all together. 3 firms, 3 paths. If you want maximum scale 20 accounts, you go with.
You go with Apex. But you have to live with that trailing drawdown. You have to be a scalper.
If you're the tech-savvy trader who wants that 100% split and the best platform.
I gotta be day traders. But you have to be patient. You'll be in that sim environment for a long, long time.
And if you're looking for lower upfront costs and a more forgiving set of rules for swing trading.
You're looking at my funded futures. No activation fees, end of day drawdown. Just don't get too lucky on one trade, or that consistency rule will bite you.
It feels like there's an option for every style, but the house always has an angle.
The house wins on emotion. It wins on greed and a lack of discipline.
So what's the final thought we should leave everyone with today?
I think you need to ask yourself a very honest question. Am I a trader or am I a gamer? Because these firms have built a very compelling, very expensive video game.
And if you treat it like a game,
If you see that 100K and you max out your leverage, you're just another player feeding quarters into the machine. You're the customer.
but if you treat it like a business,
If you treat that $3,000 drawdown like it is your entire trading account, and you apply real risk management to that number, then you can absolutely beat the game. You just have to play by the rules of math, not the rules of marketing.
read the fine print, respect the drawdown, and figure out your taxes. That's our deep dive on prop trading in 2026. Thanks for listening.